Welcome to week 2 of our Financial Policy and Strategy course. I'm Dr. Mark Dennis, and in this session, we'll be exploring risk and rates of return, a cornerstone topic in corporate finance. Understanding how to measure and manage investment risk is critical not only for financial managers, but also for individual investors. This session lays the groundwork for the capital asset pricing model and how we evaluate whether an investment is worth taking. Let's start with a simple truth. Risk is uncertainty. In finance, we define it as the chance that actual outcomes will differ from what we expected. We use probability distributions to describe all possible returns from an investment and assign likelihoods to each. The key takeaway here is the formula for a required return is made up of 3 components: the risk-free rate, an inflation premium, and a risk premium that compensates for the uncertainty or volatility of the asset. The expected rate of return is just the mean or average of all possible outcomes weighted by their probabilities. If you've ever done a weighted average calculation in Excel, it's the same principle here. Think of it as what we expect to earn based on all potential scenarios, some good, some bad, and all factored in. Let's talk about a really helpful tool for comparing the risk of different investments, the coefficient of variation, or CV for short. This is especially useful when we're looking at investments that differ not only in risk, but also in expected return. Here's the idea. The coefficient of variation is calculated by dividing the standard deviation of returns by the expected return. The formula on this slide breaks it down clearly. Let's take a moment to explain some of those symbols. The lowercase Greek letter sigma in the numerator represents the standard deviation, which is our statistical measure of risk or volatility. It tells us how spread out the potential returns are around the average. Our hat in the denominator is the expected rate of return or the average return we anticipate based on probability distribution of outcomes. Remember, the rooftop or hat over the letter R tells us this is an expected value. So what does the coefficient of variation actually tell us? It gives us a risk per unit of return measure. A lower CV means you're getting more return for each unit of risk, which is generally a good thing. If you're comparing 2 investments and one has a lower CV, that's typically the more efficient choice in terms of risk-adjusted return. This is especially useful when you're comparing things like 2 mutual funds or 2 individual stocks with different return levels. Just looking at the standard deviation alone isn't enough. CV gives you the full picture by normalizing that risk. Here's where human behavior enters the equation. Most investors are risk averse, which means they won't take on more risk unless they're compensated with a higher return. That's the idea behind the risk premium. It's the extra return we demand to bear the uncertainty of a risky asset instead of something safer, like a treasury bond. Let's unpack the graphic you see here, which is a powerful visual representation of one of the most important principles in finance, the positive relationship between risk and return. On the vertical axis, we have return, R. That's the rate of return expected or required from an investment. Along the horizontal axis is risk, which we can think of in terms of variability or uncertainty of outcomes. The diagonal red line illustrates that as risk increases, the required return also increases. Investors won't accept higher risk without the potential for higher reward. That extra reward for taking on more risk is called the risk premium, or RP. Now let's break this down into components. The risk-free rate, R sub RF, represents the dashed horizontal line near the bottom. This is the baseline. It is the return you would expect from an absolutely safe investment, typically represented by U.S. Treasury securities. That rate itself is made up of two parts. R asterisk is the real risk-free rate. Think of this as return with no inflation. IP is the inflation premium, compensation for loss of purchasing power over time. So the risk-free rate, R sub RF, equals the real risk-free rate, R asterisk, plus IP. Everything above that dashed line, the green shaded area, is the payment for risk, also known as risk premium. This is the compensation investors demand to take on various levels of uncertainty. We also label a few points along the return axis, R sub low, R sub average, and R sub high, to show that riskier assets are expected to offer greater returns. This is why the far right side of the diagram, labeled above average risk, corresponds to a much higher expected return. So if you're ever wondering how investors determine what kind of return they want from a risky asset, it's this. Take the risk-free rate and add a risk premium that reflects the amount of uncertainty associated with a particular investment. This chart also helps explain why we diversify. If you're not being adequately compensated for the risk you're taking, then you are on the wrong point of this curve, and your portfolio could be underperforming relative to the market's risk-return expectations. Now let's take a closer look at portfolio returns, starting with a key term, the realized rate of return, which we denote as R umlaut. That's right, those two dots are an umlaut. At least it is in the German language. This is the actual return that we end up earning over a given time period. It's not what we hoped for, and it's not what we projected. It's what we actually got based on market performance, asset behavior, and changes in value. The important takeaway here is that realized returns usually differ from expected returns. That's true whether you're managing a stock portfolio, a bond fund, or even your retirement investments. Forecasts are based on probabilities and assumptions, but the real world is messy. So the actual outcome often falls short, or sometimes it even exceeds expectations. This discrepancy is one of the reasons we emphasize risk analysis and diversification. No matter how much due diligence we perform, we can never completely eliminate uncertainty about investment returns. The goal is to manage that uncertainty, not to ignore it. Later, we'll connect this idea to the concept of tracking error and the importance of reviewing performance not just in isolation, but in comparison to benchmarks and expected values. Now we're stepping into one of the most powerful tools in portfolio theory, correlation, which is represented here by the Greek letter rho. I know it looks like a lowercase p, but it's the letter rho. This measures the degree to which two investments move in relation to each other. Let's put that into plain English. When one stock goes up, does the other stock tend to go up too? If so, they are positively correlated. If one tends to go up when the other goes down, we say they are negatively correlated. Here's how we interpret the values of rho. If rho equals plus 1, the two assets move perfectly together 100% of the time in the same direction. That is a strong positive correlation. If rho equals 0, there is no relationship. Their movements are random with respect to each other. If rho equals minus 1, they move in exact opposite directions. This is known as perfect negative correlation. Why does this matter? Because the correlation is the foundation of diversification. That's the reason. If we can combine assets that are not perfectly correlated, and especially if they are negatively correlated, we can reduce the total risk of the portfolio without necessarily reducing the expected return. Next, we discuss one of the most important lessons in investing. You can reduce risk without sacrificing expected return simply by diversifying. But what makes diversification work? The answer is correlation, just like we talked about previously. If two assets do not move in perfect sync to one another, their ups and downs can offset each other to some degree. This is what we mean by risk reduction through diversification. Here are some key takeaways. Combining imperfectly correlated assets lowers the portfolio's overall risk. The lower the correlation, the better. In fact, the best case scenario is a perfect negative correlation, though that's quite rare in real-world markets. As you increase the number of stocks or assets in a portfolio, your total unsystematic risk, otherwise known as firm-specific risk, begins to shrink. Think of it as smoothing out the bumps across the portfolio. It's important to note that diversification doesn't eliminate all risk. What it does is reduce the idiosyncratic or asset-specific portion of risk. That leaves us with systematic risk only, which is tied to the overall market. I always like to say, don't simply own more investments. Instead, own more kinds of different investments. Holding 15 different tech stocks is not diversification. A truly diversified portfolio spreads across different industries, asset classes, and even geography. So the bottom line, the smaller the positive correlation, or the more negative the correlation, the greater the potential for risk reduction in your portfolio. This is a fundamental strategy behind modern portfolio management. This next chart is a classic way to visualize the power of diversification in managing portfolio risk. Let's walk through what's happening here. On the vertical axis, we have portfolio risk, represented by sigma sub p, which is measured as a percentage. This is the total standard deviation of portfolio returns. On the horizontal axis, we have the number of stocks in the portfolio, starting from just one stock and moving toward a fully diversified portfolio with 40 or more stocks, such as those found on the New York Stock Exchange. Now, observe the red curve. This is showing how total portfolio risk behaves as we add more and more stocks to a portfolio. On the far left, with just one or two stocks, the total risk is very high, around 30%. But as we increase the number of stocks, total risk drops sharply at first. That steep decline represents the reduction in what we call diversifiable risk, also labeled here as unsystematic risk. This kind of risk is related to individual company events, things like product recalls, lawsuits, or management scandals. Once we get to around 20 to 30 well-diversified stocks, that green shaded area begins to level off. This is where we've squeezed out most of the firm-specific risk. Beyond this point, adding more stocks does not reduce risk very much. Now take a look at the horizontal dashed line toward the bottom. This represents the minimum attainable risk in a portfolio, the portion we cannot diversify away. This represents the systematic or market risk shown here in orange. This is the risk that comes from broader economic factors like inflation, interest rates, or recession. It affects all companies to some extent, regardless of industry or size, and it cannot be eliminated through diversification. So what's the bottom line here? This chart clearly shows why diversification is so effective. You can reduce a lot of total risk just by combining a variety of stocks. But there is a floor below which you cannot go, no matter how diversified you get. This sets the stage for the next part of our discussion, where we break down firm-specific risk versus market risk even further. Now that we've seen the graphic showing how diversification reduces risk, let's zoom in on one half of that equation, firm-specific risk. Firm-specific risk is also known as unsystematic risk, diversifiable risk, or even just idiosyncratic risk. This is the type of risk that is tied to events or circumstances that only affect one company or perhaps a small group of companies. Think about things like a CEO resigning unexpectedly, a defective product recall, a cybersecurity breach, or a company missing its earnings targets. These events can cause a big move, either up or down, in a particular stock's price, but they do not necessarily impact the broader market. And that's the good news, because these risks are specific to individual companies and they can be eliminated by holding a diversified portfolio. When you own 20, 30, or more stocks across different sectors, the odds that a single bad event in one company will take down your whole portfolio drop dramatically. So when we say this type of risk is irrelevant, we mean that in a technical sense. It is irrelevant to the rational investor who diversifies properly. You're not compensated for taking on unsystematic risk because that is avoidable. If you don't diversify and something goes wrong with one stock, that is on you, and the market will not pay you extra for it. In short, firm-specific risk is controllable and should be managed away through diversification. Now let's turn to the other half of the risk equation, market risk, also referred to as systematic risk or non-diversifiable risk. Unlike firm-specific risk, this type of risk affects the entire market or economy, not simply one company or one sector. This is why we cannot eliminate it through diversification. Examples of market risk include changes in interest rates, inflation surprises, geopolitical tensions or war, recessions or major shifts in the business cycle, or pandemics and global supply chain interruptions. The key point here is that even if you own hundreds of stocks across different sectors, you are still exposed to these kinds of forces. No amount of diversification can protect you from a broad market downturn. When the entire economy is impacted, nearly all asset prices move together, and usually downward. This is why we call this non-diversifiable risk. It's part of the investment environment, and investors must accept it as the baseline level of uncertainty that comes with participating in financial markets. So while firm-specific risk is something we can control and eliminate through strategy, market risk is what we're compensated for when we invest in riskier assets. This is where the risk premium comes into play, which we'll revisit when we get into the CAPM and security market line discussions. In short, market risk is unavoidable, but it can be measured, it can be priced, and it can be managed through asset allocation, hedging strategies, and setting appropriate return expectations. Let's tie this together and look at what we've just discussed by framing risk in terms of what really matters, what is relevant, and what is irrelevant to investors when making decisions. Breaking it down. Relevant risk refers to the portion of an investment's risk that cannot be diversified away. This is market risk, the systematic risk that affects all securities to some degree. It is relevant because it's the part of risk that still remains even in a fully diversified portfolio. It's what investors are compensated for when they demand higher returns from riskier investments. Irrelevant risk, on the other hand, is the firm-specific risk that we can diversify away. If you're holding a broad portfolio, the unique risks tied to any one stock don't matter much in the big picture. This is why the market doesn't reward investors for holding undiversified risk. In fact, they are penalized with unnecessary volatility. In finance, we often say that only systematic risk matters in pricing assets, especially in models like the Capital Asset Pricing Model, or CAPM, which we'll get to shortly. CAPM assumes that rational investors hold diversified portfolios and therefore only care about relevant risk, the market risk that moves along with a figure called beta. So if you're ever trying to evaluate whether an investment is offering a fair return, you need to ask, how much relevant or systematic risk does it have, and am I being compensated for it? The takeaway here is simple but powerful. Don't waste your risk budget on something the market will not reward. Diversify away the irrelevant stuff and focus on managing the risks that actually move the needle. All right, folks, now that we have laid the groundwork with systematic and unsystematic risk, we are ready to introduce the concept of beta. which is the measure of an asset's exposure to market risk. Beta is central to how we think about an individual asset's contribution to portfolio risk, specifically the systematic portion. In other words, beta tells us how much a security's return tends to move in response to changes in the overall market. Here is a good way to think about it. The market portfolio, which includes all investable assets, is considered perfectly diversified. By definition, the market has a beta of 1.0. An individual stock's beta measures how volatile it is relative to that market. Let's look at a quick example. If a stock has a beta of 1.0, its price moves in line with the market. If the market goes up 10%, the stock is expected to go up 10% as well. If a stock's beta is greater than 1, say 1.5, it's more volatile, more risky than the overall market. You can think of this as high-octane fuel, bigger swings in both directions. If a stock's beta is less than 1, say 0.5, then this stock is less sensitive to market movements. These are often more defensive stocks, such as utilities. The idea here is that beta isolates the relevant risk for diversified investors. You could hold a perfectly diversified portfolio and beta would still capture how much each individual security contributes to the portfolio's market risk. In short, beta is the bridge between a stock's individual behavior and its role in a well-diversified portfolio. And this concept becomes especially important as we move into the capital asset pricing model, which uses beta to determine the required rate of return on a stock. Now it's time to put some numbers to the concept of beta so you can get a better feel for what it actually means in practice. Beta equals 0.5. This stock is only half as volatile as the overall market. If the overall market increases by 10%, this stock would be expected to go up by only 5%. The opposite is also true. If the market drops by 10%, this stock would likely drop by half that amount, or around 5%. Stocks like these are typically considered defensive. Examples include utility companies or consumer staples. Beta equals 1.0. This is the benchmark. A stock with a beta of 1 moves in lockstep with the market. If the S&P 500 goes up 8%, this stock is expected to go up 8% as well, or down for that matter. Many broad-based mutual funds or exchange-traded funds that track the market tend to behave this way. Beta equals 2.0. This illustrates high-risk, high-reward territory. A beta of 2.0 means this stock is twice as volatile or twice as risky as the overall market. When the market moves up 10%, this stock might jump 20%. But if the market drops 10%, this stock could fall by twice that amount, or 20%, in a negative direction. These represent aggressive growth stocks, often in tech or emerging industries. The key insight here is that beta is not simply a technical statistic. It directly impacts an investor's experience. Higher beta means higher expected return, but it also comes with higher risk. Now let's put some numbers to the concept of beta so you can get a better feel for what it actually means in practice. Let's walk through these 3 examples. Beta equals 0.5. This stock is only half as volatile as the market. If the overall market increases by 10%, this stock will be expected to go up by only 5%. The same is true if the market drops by 10%. This stock would likely drop by just half of that at 5%. Stocks like these are typically considered defensive. These are companies like utility companies or consumer staples because their performance tends to be less tied to economic cycles. What about where the beta is equal to 1.0? This is the benchmark. A stock with a beta of 1.0 moves in lockstep with the broader market. If the S&P 500 goes up 8%, this stock is also expected to go up 8%. Many broad-based mutual funds or exchange-traded funds that track the market tend to behave this way. Beta equals 2.0. Here we are in high risk, high reward territory. A beta of 2.0 means this stock is twice as volatile as the overall market. When the market moves up 10%, this stock might jump 20%, but when the market drops 10%, this stock could also fall by 20%. These tend to be more aggressive growth stocks, often in tech or emerging industries. The key insight here is that beta isn't just a technical statistic. It directly impacts an investor's experience. Higher beta means higher expected return, but also higher risk. And lower beta offers more stability, but with lower return potential. Now that we've introduced CAPM as a formula, the security market line, or SML, gives us a visual representation of that relationship between risk and return. Here is how it all works. On the horizontal axis, we plot beta, the Greek letter B. This is the measure of systematic risk. On the vertical axis, we plot the required rate of return, R. The security market line starts at the risk-free rate, which is the return you would expect from an investment with zero market risk, typically a treasury bill. From there, the line slopes upward, showing that as beta increases, so does the required return. So what does this tell us? Any security that lies directly on the security market line is considered fairly priced. It offers a return that matches the level of market risk that it carries. A stock that lies above the security market line is underpriced or undervalued. Why is this? This is because it offers a higher return than its level of risk would require. That might signal a buying opportunity. A stock below the security market line is overpriced or overvalued. It offers too little return for the amount of risk you are taking on. Rational investors will typically avoid these. The slope of the security market line is determined by the market risk premium. That's R sub M minus R sub RF. The steeper the slope, the more return investors will demand for each unit of risk. This concludes our lecture for this portion of week 2. Stay tuned for more to follow.